When it comes to the stock market, history has a strange way of repeating itself. Over the last century, one month has consistently stood out as the most troublesome for investors: September. Whether you're a beginner just starting to invest or someone who's been watching the markets for years, you've probably noticed the pattern. Stock charts dip, headlines scream panic, and portfolios take a hit. But here's the big question: why does this happen? And more importantly, how should you, as an investor, respond to it? If you look back across the last 100 years of market data, you'll find that September has historically delivered weaker returns compared to any other month. Even major financial institutions like J.P. Morgan, Goldman Sachs, and Bloomberg have documented what's known as the September effect. This effect isn't about one bad year or a coincidence, it's a recurring theme. The Dow Jones, the S&P 500, and the Nasdaq have all shown this seasonal weakness in September more times than any other month. Now, this doesn't mean every September brings a devastating crash. Sometimes the losses are mild, sometimes they're more dramatic, but the consistency of the trend makes it worth paying attention to. And if you're serious about building wealth, it's critical to understand whether this is just a superstition or a real opportunity. Because while most investors panic and sell during downturns, the smartest investors, think Warren Buffett, Ray Dalio, or Peter Lynch, look at dips as discounts. So in today's video, I'm going to break down 1. Why September has been the worst month for stocks historically. 2. The psychology and financial factors that make this month different. 3. How you should approach investing during these dips. 4. Why a long-term strategy beats short-term panic every time. By the end of this video, you'll not only understand why September often feels like a market nightmare, but you'll also learn how to use these downturns to your advantage. Instead of fearing the dip, you'll know exactly how to prepare and invest smarter when everyone else is panicking. Let's dive in. The September effect isn't a myth or an internet rumor, it's a well-documented financial phenomenon. For over 100 years, September has been the weakest month for stock market performance across major U.S. indices. Data compiled from the Dow Jones Industrial Average, S&P 500, and Nasdaq all tell the same story. When you compare average monthly returns, September consistently ranks at the bottom. According to the Stock Traders Almanac, from 1928 through today, the S&P 500 has averaged a decline of about 1% in September. That may sound small, but when compared to the average gains of other months, it's significant. Imagine earning 1–2% in gains most months, only to have September wipe out the progress. That's why traders and analysts pay so much attention to this month. The September